Hello and welcome to Gold and Silver Assets. It's Sunday the 17th of January 2021. There's a lot of debate out there regarding whether we are heading into deflation or inflation. And there are plenty of very highly experienced people out there who have put forward really logical and intelligent arguments for each side. I'm not actually going to cover that over here as it's far too big a topic. But I thought it would be useful to go through how investment strategies differ depending on whether we are in an inflationary or deflationary environment. Here's a list of possible economic environments. It's possible to have deflation and high growth due to technological advances, for example. However, people are more familiar with deflation associated with low growth. And that's what central bankers are most petrified about and want to avoid at any cost. A low inflation environment is seen as stability. High inflation can be associated with high growth. For example, when demand for goods is increasing and suppliers are struggling to keep up with the demand. Businesses are doing well and the economy is running hot. Finally, we come to high inflation, low growth environment. In this case, it's more of a supply side issue where the supply of goods has decreased, businesses aren't doing well, and unemployment is high. If we look at the historical consumer price index in the USA, we can see that before 1905, there were wild swings between deflation and inflation, and these were high magnitude. Since the introduction of the Federal Reserve in 1913, we can see in green here that the swings became much less pronounced and deflation occurred less often. Since coming off the gold standard in 1971, we've been in a purely inflationary environment. It started off quite high in the 1970s and has become lower over time. You might say, well, didn't we have deflation in 2008? And some charts do show that CPI went to about -0.5%. But it does depend on how you measure inflation. If we use the official government CPI, then yes, you could say that we had a very mild level of deflation in 2008. However, if we use the shadow stats figures shown in blue, then we didn't actually have any deflation. Instead, we had disinflation, and that's shown by the drop in the blue line. And that's a very different animal from deflation. And that begs the question, is true deflation possible in an era when the world's reserve currency is fiat? We don't actually have any historical examples of this. When looking at asset returns in these environments, we do need to take the inflation rate into account. Nominal returns can be misleading, especially when inflation is high. For example, a stock price going up by 10% when the inflation rate is 12% means that the stock is actually losing in real terms. And that's something that's not well understood by the general population. But the real return is far more important than the nominal return. Let's start by looking at inflation beta. This is how much an asset's return increases when inflation goes up by 1%. And so it reflects the inflation hedging property of an asset. The blue bars here show that gold and commodities have the best beta to inflation, but also note that they do tend to be very volatile. Bonds have a lower beta, but are also less volatile. And equities have a negative beta and are volatile, so that's not a good combination. Let's look at real assets returns during different economic environments. This study looked at the returns between 1970 and 2015, and they split the data into inflation below versus above the median CPI. When inflation was low, shown in blue, then we can see that real estate and stocks performed the best. Cash and especially commodities did poorly. When inflation was above median, then commodities did by far the best, followed by real estate and then equities. Again, cash did poorly. Note that this study did not include gold. This study looked at inflation as falling, stable, or rising. When inflation is falling, then commodities do terribly and equities ruled. When inflation is stable, then everything does reasonably well. When inflation is rising, then equities and real estate do badly, and gold and commodities perform the best. Interestingly, the metals outperform the mining equities. The results are different from the study in the last slide because this is using different parameters. So the previous study looked at above and below median inflation, whereas this study looks at the direction of movement. Another way of looking at it is to use the numerical value of inflation. This study showed that when inflation is below 1%, then commodities are a terrible investment and equities give the best return. When inflation is between 1 and 5%, all assets do pretty well. And when inflation gets above 5%, commodities are the best investment and bonds are the worst. Just as a side note, I just wanted to have a look at how commodities are doing. And this is a chart of the Goldman Sachs Commodity Index on the monthly scale. This looks, to me, like quite a bullish pattern that's forming. If price breaks above that upper trend line, then that suggests that commodity prices are likely to rise substantially, suggesting that we could be entering into a rising inflation environment. But of course, we can't make that call until we actually see the breakout. Looking at the ratio of the commodities index to the S&P 500, it's currently well below the median level. And in fact, it's the lowest it's been in 50 years. And in fact, it's getting about as close to zero as you can get. Does that mean that there is limited downside for commodities versus equities? Anyway, let's go back to looking at asset returns. In summary, when inflation is rising or when it's over 5%, then gold and commodities give the best returns. In an environment where inflation is falling or below 1%, then real estate and equities give the best returns. Having said all that, all the studies that I've shown here looked at inflation that was within a relatively narrow band of between 0 and 13%. But what happens at extreme levels? None of the studies that I showed included significant deflation because there hasn't been any episodes of significant deflation in the fiat era. We can look at data from the 1930s episode of deflation, but note that at that time the gold standard was in place and the price of gold was fixed, so it's hard to draw any conclusions about gold from that time. This table shows that in the 1930s, the average inflation for the whole decade was minus 2.1%, i.e. deflation. And during that decade, bonds gave the best return and stocks and commodities did badly. Now, I did find it quite difficult to get any more data than this. I would have liked to drill down on this on an annual basis so that we can look more closely at this, but I just found it very difficult to find any direct comparisons for that. In summary, when there is deflation, i.e. a negative rate of inflation, then bonds are the best place to be. The jury's out regarding gold. Let's move on to the case of high inflation. And a recent example can be seen in Argentina. Here we see the chart of the rate of inflation in Argentina, and it's interesting how there's a lot of volatility here with steep rises in inflation followed by bouts of disinflation. In 2019, inflation got as high as around 58%. What happened to equities during that time? Well, according to this chart, it looks like they did very well in nominal terms. And note that volatility has increased more recently. Gold priced in Argentinian pesos has also done extremely well. But of course, remember that these are all nominal values. How did they do in real terms? Well, if we index everything to 100 in 2011, then we can see that both stocks and gold outpaced inflation. But interestingly, gold outperformed twice as well as equities did. Let's go to the more extreme example of hyperinflation in Venezuela. If we look at the stock market, that looks great, doesn't it? It's a vertical rise up. However, you can see that when we index it, then in real terms, it's actually not even been close to keeping up with inflation. Meanwhile, gold has provided huge real returns that have very much outpaced inflation. In summary, when inflation is very high, and we're talking about above 20%, then gold, commodities and equities will provide the best returns in that order. When hyperinflation hits, then equities won't actually do so well in real terms. The place to be is gold and commodities in that situation. In conclusion, when considering how you allocate your investment portfolio, it's really important to consider the economic environment. Over the past 40 years, we have been in a relatively stable environment without any large amounts of inflation or deflation, and so equities and real estate have done very well. Will that environment continue? And if not, which direction do you think we're headed? Now, I've changed my mind about this a few times, and currently I'm thinking inflation with bouts of disinflation. But of course, I change my mind as new data comes in. So let's just see what happens. It's also important to note that deflation and disinflation are not the same thing and should not be confused. We should also be assessing whether we are in a period of economic growth or economic decline. Now, I came across this chart which shows which assets outperform in different environments. The upper half is for rising inflation and the lower half is for falling inflation. The left side is for economic decline and the right side is economic growth. Which quadrant do you think we're headed into? Next up, the market update. Well, the metals and the miners certainly got smashed this week, didn't they? Let's go through what's been going on. So we'll start with gold priced in US dollars on the daily scale. And this correction has been going on for ages. It's been quite frustrating with all these ups and downs here. And it's dragging on, let's face it. We were hoping that this breakout was a positive sign that we were going to come out of that correction, but price just promptly turned around and has been dumping. So we had a little bit of a choppy few days over here. And we've also been talking about this zone here, which we're postulating to be a strong support zone based on the price action from 2012-ish. Well, what's going to happen from here? Are we going to be flipping into bearish territory? Well, at the moment, I'm still maintaining that this is a correction in a bull market. To me, it doesn't seem like this is a trend change. I don't think that this is the peak and we're heading into a bear market here. So that's the first thing to say. If this is a correction, the big question is what's the lowest it's going to go? I had thought that this was it, and it could still be, but you know, we just have to let the market tell us what it's going to do. I don't know the future. So at the moment, I have to say that I think there is more downside coming. I don't think this move has finished yet. And I think at least we're going to go back into this zone. What I'd like to see is that if we do go back into this zone, we would get a kind of nice lower wick, and then price would kind of rebound off of that. Now, there is another possibility here, and that is of this channel line here. Now, again, this isn't perfect here because you can see that I've cut off this outlier over here, but also over here we could say that we've cut this off as well. Are these false breakouts? So, you know, this isn't a perfect thing here. It's quite tricky to work out what's going on here. But what I would say is if we go below this support zone, if we look back here, we do have some good support at around the 1750 level, and then again at around 1720. And that would 1720 would fit with where the bottom of this is. But, you know, I think for me, I would want to see price turn around and bounce back up some point within the next couple of weeks. If we see a strong move down and a solid candle with not much of a wick and no bounce of, you know, any particular strength, then I'm going to be getting quite worried. We would be potentially looking at much lower prices there. But look, I'm still looking on the bright side. Who knows what's going to happen? We just have to wait and see. But yeah, I'm working on a bounce occurring somewhere within this zone, and then the second possibility is somewhere within this lower zone here. Let's look at silver priced in US dollars. And we had what looks like this triangular shape formation. And we had a nice breakout from there. And we anticipated some problems in this region because of this price action over here. Price got smashed down. We had a very weak bounce, and price has come down again in the last day. I still think that there's a bit more downside. And we had spoken quite a few times about how if we were to get a breakout above this, we can get a retest of the top of this triangle here. So there's a couple of support areas. As with gold, I think there is a bit more downside to come. I think that if we break this low over here, we've still got support around 24, and then if we were to retest this triangle, it depends when exactly we retest it, but we're looking at around the 2350 level there. And again, I would like to see a bounce up from there going forwards. Anything dropping below this 22 level, then there's thin air here. Then we would see price plummet pretty sharpish. But no, I'm still going to be positive about this. I think that this is a breakout from this triangle. We've had a breakout, we're going to have a retest and then come back up. That's what I'm working on, but let's see what happens. And the miners, again, we had kind of anticipated this because we were talking about this being a potential flag with this as a kind of an upside down pole. Then we got this flag, and then I think we've got one more move down, and 32 roughly is the support area that we were looking at. And in terms of a measured move, if you look at the height of this, that would fit with a drop to 32. And I would want to see price bouncing off of that level and then turning around. Why are we looking at 32? What's so great about 32? Well, if we look at the GDX on the monthly scale, so this is a nice long-term chart here. And I mean, one way of looking at this would be a double bottom. So this is a kind of Eve and Adam bottom. And when we have a breakout from a bottoming formation, then you can get a retest of the highest point within the bottom, which is over here, which is around that 32 level. And you can see that there's been a few times where it's acted as a resistance, but now that we're above it, then I would anticipate it acting as some support. So I'm thinking price will come down here and then restart its march upwards, and I think we would hit resistance at about 54 because of all this price action over here. Anyway, that's my thinking. Now, these support levels aren't necessarily exact. There can be a zone of support. So if we look further down here, this seems to be quite supportive over here. So it could even go as low as 30. But I think if we start dropping below that, then it'll be looking worrying. But then, you know, we'd be looking at quite a long time where prices would be dropping and being low. I don't know if I buy that happening, but who knows. Let's look at the GDXJ. So this is the juniors on the daily scale, and we've got what appears to be this kind of broadening formation. Again, we had a nasty drop over here in the last trading day, and I've drawn this support band over here. It's possible that price goes to the bottom of this broadening formation over here before turning around. Or it could turn around before then. But I think this area should hopefully be supportive. Let's look at the silver miners. And so this is the SILJ on the daily scale. And we've drawn this curved shape. So initially, I think we'd drawn some straight lines so it looked like a flag initially. But then as price action progressed, we turned this into a curve, and it was interesting because price kind of paused at where we'd drawn that curve, but then it just broke right through there. So we're going to have a rethink of this as well. How bad could this get? Well, I think there is some good support over here at 13. If we are to see further drops in silver and gold, like I suspect we are, then, you know, that's a distinct possibility. And then, so what kind of formation are we looking at here? Well, maybe this is a channel on a larger scale, in which case we'd want to see price bounce off of that 13 level. Not sure what else this could be, really. Yeah, this one's got me a little bit stumped, but yeah, I'm expecting some more downside, I'm afraid. If we go below 13, then things could get pretty ugly. We're talking about some hairy, scary times if that's the case, and we'd be looking at targets down here. Do I think that's going to happen? Not convinced. Looking at the miners, from a lot of them, I'm seeing a little bit more downside, but I'm not seeing anything catastrophic. But look, I could be wrong. The market will do exactly what it wants to do, and we just have to listen to what it says. Well, anyway, all of this kind of downwards movement is going to scare people, and it is going to affect sentiment. But remember, when sentiment is at its lowest, that's when price turns around, and it can actually run away pretty quickly. So overall, I'm still bullish, but as I said, in the short term, I'm expecting a little bit more downside. That's all for this week. Thanks to everyone for your comments. We had one of our viewers a couple of weeks ago who actually mentioned how they find the comments really useful. There are some great bits of information that people very generously give out in the comment section, and I find it really useful as well. So thanks for that. I do try and answer as many comments as I can. Now, what I've been finding is that some comments do get missed. What happens is sometimes I see them in the notifications, but I can't read the whole thing. But then when I click on it, it somehow disappears and it doesn't show up in the back end. So if you don't get a reply, I'm not necessarily ignoring you. It's just the way the YouTube back end is functioning. Anyway, thanks to everyone for your contributions. All the best and see you next week. Bye.